It's obviously a gut-wrenching time for the economy. All over the world, the economic downturn is continuing, according to the latest numbers that we've seen. And with that downturn, people are being laid off, people are cutting back on expenses. It's a situation where, as I believe, by the time it ends, we will have been through the worst economic downturn since the 1930s. My objective today is to place economic, financial developments in labor markets in perspective, to clear up much of the confusion that often surrounds these developments, and to provide you with some information as to where the economy is headed, why it's headed in that direction, and what the impact is likely to be both short and long term on the various labor markets. The essence of economics is, how do you get people to combine resources in the most efficient way possible to produce things that other people want? And it turns out economists figured this out a couple of hundred years ago when the classical economists wrote, people will naturally put resources together in the most efficient way possible to produce things other people want, so long as they have the right environment. And the right environment consists of giving them only four things, what I call the classical principles. They said you have to give people low tax rates, free markets, you have to protect their property rights, and you have to give them a stable currency within which to transact business. It turns out the classical economists who wrote 200 years ago were absolutely right. In this country or any other country, whenever policies moved in the direction of these classical principles, we've had better economic performance. And whenever we've moved against them, we've had disappointing economic performance. And this has happened not only in the United States, but around the world. The real key is the central bank. And in our case here in this country, it's the Federal Reserve Board. The Federal Reserve Board is the 800-pound gorilla that dictates whether or not we spend a lot or a little. The more checks the Fed writes, the more of these bank reserves that exist, the more liquidity can come into the system. And usually, historically, it takes about 6 to 9 months after the Fed has increased money rapidly before you see spending increase, or if the Fed is decreasing the amount of reserves in the system, it takes 6 or 9 months before the effect of that hits the economy in terms of a slowdown. So where is the general economy going? As I mentioned before, the Fed is putting in the money, and as a result of the Fed putting in the money, I expect that by this summer we will see a turnaround in the economy. What's the effect of this on the labor market? Labor markets tend to lag. And so, businesses want to make sure that the upturn that they see is for real before they start to go out and hire. As a result, I expect that we won't see a turnaround in the labor market until the beginning of next year. What about the long-term demographics? What do they suggest for labor markets? Looking at all the major countries in the world, what we can see is that as we go out over the course of the next decade or so, each of them will find a reduction in the rate of growth or an absolute decline in the working age population. What this means is that the number of qualified workers is going to become progressively more scarce as we go over the next decade or so. I think it's important to understand the pressure on your clients. At the moment, most of them, or many of them, are in a survival mode. They're in a mode of conserving capital, trying to allocate funds very cautiously. In many cases, budgets are being monitored on a monthly basis to make sure that the firm is going to get through this period. In addition, because of these wild swings in the economy, first down and then up, there's a struggle to adapt to the very rapidly changing economic conditions. What does that suggest for recruiters? What sort of strategy makes sense? I believe the first most important thing is to recognize the economic pressures on your clients. It's important to understand where they're coming from, what sort of pressures they're experiencing, and prepare for the sort of changes that lie ahead. I think one thing you have to do is anticipate the need that your client's going to have for labor, particularly as the economy recovers. If my analysis is correct, you're going to see a very sharp turnaround in economic conditions by next year. And all of a sudden, companies that were cutting back furiously are going to start to see the need to expand. In addition, I think you have to make sure that your clients are aware of the fact that we are entering an extended period where there will be a shortage of qualified labor. I believe we'll see an increase in the demand for workers next year, although I expect that it's going to be a fairly modest increase, but I believe that the demand will grow even further in 2011 as we start to see robust economic activity, as we start to see demands on resources. My first conclusion is a pretty standard thing that I think most people know about. The problems in the financial area began with problems in the housing area. As a result of that, too many houses being built, we had too high inventories, the prices came down. When the prices came down, the value of financial assets associated with housing fell sharply, and any financial institution that held those assets found that they had big losses as a result of that. My second conclusion is that errors in government policy took the problems from the housing area and spread those problems to the rest of the economy. Government policies are primarily responsible for the economic downturn that we have. It was not the individual. It's not people sitting around the table clipping coupons that caused a tremendous collapse in the economy. My third conclusion, and the one that I think is on the top of everyone's mind, is when can we expect an economic recovery? My answer for that is we can expect an economic recovery 6 to 9 months after the central banks start to put more money back into the economy. If my analysis is correct, that means that the economy should turn around sometime this summer. Historically, the sharper the economy goes down, the sharper it recovers. And I see all the ingredients for that happening again.